Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In this video, I'm going to talk about making lemonade out of lemons or losses. So when we produce this video, it's in the midst of a bear market volatility. In 2020, as an example, we saw quite a bit of market volatility in the month of March, but because of a very harmonized response by governments and central banks around the world, the markets began to rebound. We're now in another market upheaval period, and it's obviously frustrating and anxiety producing for many investors. But there's one silver lining, and that's the fact that you can actually benefit by harvesting some of the losses that you might be experiencing on your portfolio and using those losses to offset future capital gains. So I've just put out a circular that McKinsey Financial put out last year. Even though it was last year's information, it's still very relevant to any period where there might be some market volatility and might provide you an opportunity to trigger some losses on your portfolio, capture those, book those, and use those to offset future capital gains on your portfolio. So let's take a look at that in more detail. Now, if you're new to our channel, make sure you hit the subscribe button so you don't miss future content. If you like the video, click like. So let's take a look at making lemonade out of tax losses. So to begin with, tax loss harvesting is only a strategy that's relevant for your non-registered portfolio. So it does not apply to your RSPs, your RIFs, your tax-free savings accounts as an example. But for your non-registered portfolio, if you have a corporate investment account as well, you can trigger capital losses to offset capital gains. Let's take a look at a few basic pointers in this area. So the first thing is, when it comes to tax loss selling, when a taxpayer realizes a capital loss, 50% of the realized loss will be considered for tax purposes as an allowable capital loss to offset any taxable capital gain, being 50% of any realized capital gain. While the utilization of allowable capital losses is limited to taxable capital gains, the Income Tax Act allows a taxpayer to carry back unused capital loss balances for a period of 3 years or carry them forward indefinitely. So these rules apply to individuals and corporate taxpayers. For individuals who have already realized tax losses or those contemplating the option to sell their current investments held in non-registered accounts, the following tax strategies will allow them to convert capital losses to tax advantages. So again, as a practical matter, what you need to do with your portfolio or with your advisor, take a look at those assets where the what's called adjusted cost base of the portfolio is less than the current market value. And your financial firm will have that information and walk you through that. So go through each of those holdings and see which ones may provide an opportunity to realize a loss. So what you have to do is physically sell the security, book that loss in your account. Now, once you sell the security, there's a few things you need to keep in mind. The first thing is you need to bear in mind the superficial loss rules. So when it comes to superficial loss rules, it's a set of rules that prevent a taxpayer from deducting the capital loss where before or after the sale of a property, the same property or an identical property referred to as substituted property is purchased, either by the taxpayer or an affiliated person. Here's the crux of the issue. There is a period of time in which an investor or affiliated person cannot buy a substituted property. The period is 60 days, consisting of 30 days preceding the sale and the day of the sale and the 30 days following the sale. Capital losses of investors who purchase substituted properties during this period will be denied or added to the adjusted cost base of the substituted property. So the basic idea is that when you sell an asset, a security, and trigger a capital loss, you cannot buy back that same security for a period of 30 days. And so you can find investments that might work somewhat similar to that investment. So one of the issues about triggering a loss, of course, is if you are in a market that is gone down, it's in a bear market cycle, always one of your concerns should be, I don't want to be out of the market when the market begins to take off because I might lose some of the momentum because I've triggered this superficial loss and maybe gone to a cash account or something more conservative. So you'll want to take a look at your portfolio or talk to your advisor and find out if there's some alternative investments you can move to shorter term. That if the market begins to move, those investments will capture some of that upward movement. So as long as it's not identical, it allows you sort of to have your cake and eat it too. You sell the security, trigger the loss, put it into another security that would benefit from any momentum in the stock market, ride that momentum if it happens, and then once you get past that 30-day period, you can always liquidate the stock, and if you like the security that you sold, you can always buy back the security at that point. So that's how you make lemonade from lemons. That's tax loss selling. So it's not to indicate in any way that bear markets or volatile markets are easy markets to go through. It can be very frustrating. But we can leverage from a tax standpoint these losses to offset either gains in the future or gains in the last 3 years. So again, make sure you talk to your advisor, find out whether this is an opportunity that you should be exploring. And again, if you don't want to miss future content on our channel, we post content on a regular basis on retirement income planning and overall wealth planning. Make sure you hit subscribe. If you like the video, click like. And if you're interested in learning more about our complimentary retirement income planning service, just go to the show notes. There's a link back to our website, and our homepage reviews that service in more detail. Anyway, wishing you all the best in your retirement income planning and overall wealth planning journey. Take care.